In this video, guys, we're going to talk about outside in versus inside out trading strategies. Stick around. Hey traders, a very warm welcome to you. Thank you so much for joining me. Okay, so trading strategies, inside out versus outside in. Let's run through them. And I also want to run through some basic, very simple overviews, some strategies for each of these buckets of styles, if you like. And so inside out strategy is basically when you're saying, okay, hey, I think the market is going to push back to extremes. So you're hoping the market's going to go to fresh territory. Imagine a spring, okay, and the spring's there and you think, hey, I want to ride it while it's stretching, try and come off it before it snaps back. And so inside out is you're thinking of the market rotating down and pushing back up, extending its stretch. Sometimes it's called trend trading, sometimes it's called momentum trading, that type of thing. Now, outside in is the opposite. It's the market saying extreme, you think that's too much. It's got to contract and come back to some kind of mean. We often call that mean reversion. Mean is just basically an average price. It's made up really. It can be a volume weighted average price, VWAP, could be moving average, could be a prior day's close, can be a support, can be a whole number, any number of things. And your job as a trader is to kind of define the mean if you're going to trade that. But imagine that spring again, stretching, it's there, and your job is to find it before it contracts back again. You're trying to find that sweet spot where it comes back, and that's an outside in type trade, a mean reversion trade. So some rough, very simple overviews of these strategies. By the way, all of these guys, I've talked about them in videos. If I haven't gone into as much depth as you'd like, and well, if you're just going to check that out. Anyway, first pullback. So first pullback is pretty good, solid, consistent inside out strategy. You'll basically see the price pushing up, it comes back, and your idea is to try and gauge where that pullback is going to end and for a continuation to high. So it's an inside out strategy, and you might use a moving average for that. You might choose to buy at some support. So support is when the price just stops, sort of flat lines a little bit there, and then takes off and lifts off and continues to high. Another classical inside out type of strategy, and using the right conditions are super effective. Flags, one of my favorite trading types under the right conditions, momentum type trade. Market powers up to highs, that's called the pole, and just sits there at the high and forms this flag shape. It's literally like someone waving a flag, and the idea is you're buying that for a continuation back to high. So that's another inside out trade. Even though it's kind of relatively near the high already, it's still looking for a further extension, further momentum, further trend type move. A breakout is when market moves and punches through a prior level. So imagine this here, that was the prior high, market comes up, comes back down. Well, you guys see this, hopefully you can, goes back up, and it punches back through the high. So you would buy that as it goes through, expecting a continuation, the market continue to carry on its momentum, carry on its movement, and expecting the buying to continue. So those are classical inside out trend momentum type trades. Just some brief overviews of those. I'm going to give you some rules or structure, but just so you've got an idea and you can dig in a little bit more if those take your fancy. The other one's outside in, so mean reversion stuff. This is again string stretch. I think that's the end. Okay, bang, comes back in, or that's the way you're trying to judge it. So double tops and bottoms. Effectively, double top or bottom is one high put in and another high put in at the same level or similar level. Just so it's running. Market's running. Just runs through the level, goes we'll break, and then it just stops and rolls back over again. You just can't find any momentum to break through. So you've got that double top. There's a brick wall there. And that's your outside in trade. Market's pushing. I don't know, I'm moving the mean. There's your mean. Market's pushing. And it just kind of rolls over and you'd be shorting that instance, looking for it to come back to the mean. Or to the downside. Maybe you think it's overextended to the downside, selling's too aggressive, overdone. You feel that spring's properly stretched, it's about to come back. You're trying to time that, and that might be a double bottom. Not saying it's already had a low there last week. Now it's coming again. Double bottom territory. Fake out. So it's a breakout, but opposite. In other words, right, you got a line in the sand, happens to be the high of the day, high of the week, key level, market's running up to it, have to run again, market's running up to it, off it goes, this time it punches through, and it's running, and it looks around and it goes, there's no more buyers, okay, and it turns around, it runs back. That's a fake out, that's a classical, very solid strategy for mean reversion for outside in. Market stretches, looks like it's going to run, fools everyone to think it's going to break out, and then contracts back to that mean. Again, your job is to identify what the mean is. So that's a fake out. Pin bars and wicks, similar type of thing, but they print on a chart. So a pin bar and wick, can I do this? Probably I can do it here, right? So this would be a normal candlestick. This here would be a candle with a big wick or a pin bar. So the body is kind of small and the tail or the wick is reasonably long, suggesting that it's tried to go somewhere and come back. Combine that with support and resistance, great. Combine that again with other bits like your double top, double bottom fake out, you get some power to those. So those are pretty useful pin bars, check those out. Okay, and final thing is breakouts. I put this in inverted commas because it's really a 1, 2, 3 reversal. And I didn't want to overcomplicate things, but it's kind of what it is. So if you came back and an example, you put a high in and maybe this was a lower high, say, I'm trying to ruin this a little bit. Is that a lower high? It's not the best drawer in the world. Lower high. Anyway, as it comes back through this level here, that would be a breakout. You'd be selling that as it came through a prior low. That's still an outside in trade. It's not right at the spring. You're not waiting for the spring to be here. You're kind of selling it when the spring's here and you think the momentum's already started for a further move. So you start shorting this for a further move down to here. So it's not quite looking for the extreme, but it's still outside in because you're still expecting the market to carry on contracting lower. You're just waiting for it to start before you initiate your short position or vice versa for your long position. All right, guys, trading strategies inside out versus outside. And if you like this kind of stuff, then please subscribe to the channel. We have a lot of videos covering strategies, mindset, discipline, profitability, blah, blah, rules, all this sort of stuff. Some great books to look at, all this type of stuff, everything for a trader. So if you love trading, I know you will enjoy being a subscriber. Take care. I'll see you next one. Bye-bye.